Yes, sir, baby. Yo, what is going on, guys? Welcome to another video. In today's video, we are going to talk a little bit about why the stock market, in my opinion, is going to continue to get murder, she wrote, why I believe it's going much, much lower. And we're going to talk about a little bit of bad news that I am continually starting to see all over the news cycle. And so let's just go ahead and get right into everything. Oh, we're also going to address why I bought a little bit of stocks too. So we're going to talk about that as well. So let's just go ahead and get right into this video. We'll get to why I nibbled a little bit at the end. And it's actually not that hard of a concept. I mean, if you just use your brain, you'll be able to understand. But let's get into the more important stuff, right? So here we go. So today, Fed Chair Jerome Powell will actually be testifying on monetary policy at the Senate Banking Committee. Investors are definitely going to be watching out for this closely, mostly because we want to see how far his hawkish tone is going to go. We know he's hawkish, but we want to see how far he's going to go and kind of where his head is at in terms of this entire inflation thing and what the Fed plans to do going forward. Thursday, you have a little bit of the exact same thing. He's testifying again on monetary policy, but this time at the House Financial Services Committee. So you have that going on. Friday, you have another Fed member speaking. FOMC member, actually, Bullard speaks. And I know what you guys are thinking. I wish some of these guys would just shut up. Stop talking all the dang time. Don't it feel like these guys talk several times a week now? It's like, when did that become the norm? But that's kind of what's going on. In other news, this is where we start to get to the really, really bad news. The Canadian CPI came in well above expectations. As a matter of fact, it came in so bad, they actually reached a 40-year high in terms of inflation, too, just like the United States. So CPI for Canada for May came in at 7.7%. This is well above the April 6.8% print and the consensus expectation of 7.3. So the CPI print even went above analyst expectations in Canada. That's not good. That's starting to point to the fact that we may get a full-on global recession. That sucks. And core measures for CPI were the highest level on record in Canada, so that's really, really bad. And other news, if you look at pre-market right now, because at the time of this recording, it is actually 8 o'clock in the morning, so we got about 30 minutes until the market opens. But right now, the S&P has already erased half of its relief bounce that we recently saw as early as yesterday, which only gained about 4% from the low that you saw last week. But right now, the S&P is already erasing that. It's so funny how these bear market rallies work. It's like they go off for a little bit, and they just immediately get erased. Like, they trick retail investors all the time. It's actually quite sad. It's funny but sad. So it's very important to understand, right, that the average bear market has several relief rallies, and they could be anywhere from 10% to even more than that. And so far, we've only had one that I could think of, maybe two. So it's very important to keep that in mind. Do not get tricked by these bear market rallies. This is going to be a bad year. Like I said, I say this all the time. Even though I did start to buy stocks, I do not expect to make money from stocks this year, and you shouldn't either. Like, this is just going to be one of those bad, terrible bear market years. And we'll be lucky if 2023 isn't like this, because 2023 could actually be just as bad, if not worse. More on that later, maybe in another video. Other news. According to a new paper from a Federal Reserve economist, the paper finds that there is slightly more than a 50% chance of a recession over the next 4 quarters and a 2/3 probability of a downturn over the next 2 years. On top of that, Bank of America also came out and said that the economy has a 40% chance of being in a recession next year. And then on top of that, this is the last thing in this video, former New York Fed President Bill Dudley wrote recently in Bloomberg Opinion that if you're still holding out hope that the Federal Reserve will be able to engineer a soft landing in the U.S. economy, it's time for you to abandon it, and a recession is inevitable within the next 12 to 18 months. Now, I think that's obvious, right? I think all of us kind of know that. But the bad news is starting to pile up, because now you're starting to see economists and smart people in banks start to catch on and start to sound a warning alarm of what's going on. And so now let's go ahead and get to the last thing, the elephant in the room. It's actually very simple. And if you don't understand this concept, then I think you either need to sharpen your skills on investing, learn more about investing, or just, I don't know, search within yourself on what your problem is, right? Because obviously a lot of people got mad at me because I'm being overly bearish, and I'm still actually very bearish. But I decided to nibble on some stocks, and I'm going to explain to you why. Well, you got to keep in mind, I haven't bought stocks in like 3 months. I'm sitting on a crap ton of cash, and I'm over here researching stocks like Facebook and Bank of America, and I'm like, holy cow, these stocks are super duper cheap. So I'm like, I might as well put a little bit of cash in there. It just kind of makes sense, especially since I have so much cash. It's not like if it goes down, I'm going to be crying, because if let's say Facebook and Bank of America, the 2 stocks that I bought, go down. Let's say they go down another like 10, 20%. Well, I've got so much cash on the sidelines, I will be able to buy more. And I think people really misunderstood what exactly I said, because I didn't say that I loaded the boat. I said that I nibble buy, and it's very important that people understand that there's nothing wrong with nibble buying good stocks that you feel are undervalued or that are traditionally undervalued by valuation metrics, right? And that's all that I did. I picked 2 stocks that were undervalued. I didn't care that the market was going on. I didn't care about none of that. I just said, I got a whole bunch of cash. Let me just go ahead and put some to work. And I think people do not understand the concept of nibble buying, so I'm going to explain this. Nibble buying, right? So when people buy stocks, let's say you got $1,000. When retail investors buy stocks, these are the people that we call dumb money. Retail investors buy stocks. They take their little $1,000 and they put 500 into Facebook and 500 in Bank of America. And then when it dips, they're like, oh my God, I don't have any money, blah, blah, blah. I thought you said that good. They do all that stupid stuff. But a nibble buy is different. A nibble buy is, instead of putting 500 into each stock, a nibble buy is taking your $1,000 and just putting $50 into each stock. You're taking a very tiny percentage of your money and you're putting it to work. This is why it's called a nibble buy. A bite is like you're taking a huge bite. Eating is you're eating the whole thing. A nibble is like, it's like crumbs. You're eating a little bit of crumbs. It's a nibble. That's it. It's just a nibble. It's nothing to lose your mind over. It's nothing to be upset over. It is literally just a nibble coming from somebody who has been building cash from his multiple streams of income for the last 3 months. It just kind of made sense here. So for me, probably won't be buying stocks anymore for a while. I just wanted to nibble buy a little bit. And the reason why I wanted to nibble buy is because I just viewed Bank of America and Facebook as just screaming deals, screaming buys, in my opinion. So the way that I'm planning to do things now is I probably won't buy stocks for a while now. I think the next buy point for me, and this is the way that I'm personally buying, I don't like using the dollar cost average term because I really think that these YouTubers use it incorrectly. They tell you guys to buy speculative, terrible, unprofitable companies every single day, and that's their way of dollar cost averaging. That is stupid to me. Now, I am essentially going to start dollar cost averaging from here on, but my dollar cost average is different. Let me tell you what my dollar cost average is. My dollar cost average is when the S&P 500 gets to certain points or when certain stocks get to certain points, right? So for me, right, Facebook, I bought some in the 160s. It's at the 150s now. If Facebook were to go to the 140s, that would be another dollar cost average for me. That's when I would start to put a little bit more cash to work. Bank of America, I bought in the low 30s. If Bank of America went to like the mid 20s, 27, 26, 25, something like that per share, I would start to dollar cost average into there again. So, and same thing with the S&P 500, because I did buy the S&P 500. If the S&P 500 were to drop another 8 or 9 or 10% from here, which it very well could and probably will, I would begin to dollar cost average again. So again, you don't have to agree with me, but that is kind of how I dollar cost average. I do it based on key levels. And the reason why I do this is because we are in a nasty bear market, and in bear markets, it's irrational selling. Like, what do you expect? You can almost bet all the money you have that we're going lower. And I never said that we weren't, and I'm still bearish. I still think that we are, but for me, nibble buying made sense. It's like, what are you going to sit in cash forever? Like, you gotta do something, it just kind of makes sense. And at the end of the day, even if Facebook and Bank of America continue to get murder she wrote, it's not that big of a deal, because at the end of the day, I got them for undervalued prices, which is the key. This is the mistake a lot of people made in 2021, is they bought a lot of stocks that were ridiculously overvalued in 2021 because of this thing called FOMO. Now, when people are buying stocks that are undervalued, they get flack for that? That makes no sense, right? So for me, now we're in a position where a lot of stocks are undervalued, so I have no problem putting some cash to work. Even if they continue to go lower, it doesn't matter. I still got it for an undervalued price, which means I am pretty much guaranteeing myself to get a pretty decent return in these stocks as long as management executes well. Obviously, every company has risk. There's not a guarantee. But I really like Bank of America. I think it's a wonderful business. I do like Facebook. I have some real concerns about Facebook, but honestly, it has gotten so cheap. I'm not even worried about those risks anymore, because you got to remember how much you pay for a stock matters. So I didn't like Facebook back when it was $190 to $200, because some of you guys who are OG followers remember I talk really bad about Facebook. But honestly, at $150, I think Facebook starts to look a lot more attractive, even with some of the risks that it has, even with they're losing numbers and they're losing users, whatever it was, even with some of those things, and they're burning $30 billion a quarter on their Meta, their Reality Labs, whatever it is. Even with those things going on, I think that this current price that Facebook has gotten to a really, really cheap valuation, especially given its free cash flow. And so I have no problem with dollar cost average in Facebook. Remember, my dollar cost average is very different than these YouTubers who lie to you and basically take advantage of you guys for clicks, and people like Larry Jones and Jeremy who tell you I'm dollar cost averaging every day, which again is stupid. So for me, like I said, my way of dollar cost averaging is at certain key levels, at certain price points. That's when I like to dollar cost average. And so yeah, that's all I can really say. If you don't understand the concept of nibble buying, if you guys don't understand the point of having like $100,000 on the sidelines, not saying this is what I have, I'm not giving away my cash position, but I'm trying to give you guys an example. Like, having $100,000 on the sidelines and only putting 2,000 of that to work, which is a nibble buy. If you guys do not understand that concept, then you have a lot to learn about investing, and you should probably really like go do some research before you come in my comments and start being stupid. Because once again, I have so much cash on the sidelines. This nibble buy doesn't mean anything. If Facebook or Bank of America continue to tank, I will be perfectly fine because I have so much cash. I can just keep buying the dip. And once again, that's my strategy. That's what I'm doing. You don't got to agree. You don't got to follow. It's up to you and whatever the heck you want to do. But remember, a lot of the way that you guys think is why they call us dumb money. So please stop being dumb money. Stop being so goddamn emotional and try to really reason and understand why I'm doing what I'm doing. Because I'm telling you right now, when this whole thing is over, when this bear market is over, when this recession is over, I am going to be set for life. I promise you that. And that is the goal. And that is what I'm doing. And hopefully I can help some of you become set for life, not by necessarily copying me, because I don't want you to do that, but hopefully I can help some of you guys be set for life by understanding the concepts, the principles, the strategies behind a little bit of my moves and what I'm doing. And so there you guys have it. That'll go ahead and conclude today's video. Thank you guys so much for watching. Feel free to like, share, and subscribe, and I will see you guys in the next one.